Suggestions are one of the things that the financial world will always have plenty of. You can discover all the investing guidance you can ever imagine in this business, no matter which path you take. Sadly, you'll eventually encounter investment myths as well. Knowing what's true from what's not isn't easy at all. Sometimes it's particularly challenging since certain conventional wisdom has been repeated so frequently that it now appears accurate, even though it's based on false information or misconceptions. You've probably heard of these before, and you may even believe them yourself. Here are some of the most common myths about investing. Number 1. To invest, you must wait till you're older. There really is no right age, is there? Instead of making use of the time they have right now, many people have a tendency to push things off or postpone them until later. Although no one can predict what will happen in the future, you may tell yourself that you still have time to engage in it. Between now and the time you intend to retire, a lot of things can happen. Your plans could be ruined by a number of different events. Anytime, the costs of living could change. Your life expectancy is uncertain, and you could get sick or perhaps pass away. With all of these considerations in mind, it would be wise to begin investing as early as possible to ensure a brighter future. Investing earlier enables you to benefit from compounding and reinvesting. No matter how little you invest, the rewards you earn from doing so will add up over time. Number 2, risk and volatility should be avoided as much as possible. Investing always carries some risk. You can't escape them. You won't benefit from selling your stocks every time you believe the market is declining in an effort to reduce your exposure to risk. In reality, this will ultimately hurt your returns. It's exceedingly challenging to try to time the market, and it's almost certain that you'll always sell too soon, delaying your returns. Diversification is the greatest course of action in this situation because it spreads the risk out and reduces loss. Through diversification, you can invest in riskier assets with the potential to provide high returns without putting your entire portfolio at risk. You must determine your degree of comfort as an investor before creating your portfolios and setting your expectations. As they say, no risk, no reward. Number 3, investing choices must be based on current returns. You can never be certain of anything while investing. Just because a stock or fund performed well previously doesn't guarantee that it will continue to perform well. It takes a flexible approach to market volatility and awareness of the risks involved to succeed in investing. What works now might not in a few months or years. The only justification for investing in a stock shouldn't be in its present performance. Number 4, the only options to invest for retirement are through a 401k and Social Security. Although popular, employer-based retirement plans such as 401ks are not the only option to save for retirement. IRAs are among them. Nobody can predict the future of Social Security, and many investors have personal experience with the ineffectiveness of employer-sponsored retirement programs. The greatest method to safeguard one's financial future is to start early and diversify across a range of investment instruments. Number 5, the most secure investment is gold. The idea of making a gold investment is highly alluring. The gold investment theory is based on the notion that fiat currencies will depreciate as a consequence of money printing. Several people choose to place their long-term investments in stocks and other assets as opposed to fiat currencies. It is wrong to invest in gold with the assumption that its value will never decline. Just like every other investment or financial asset, gold is susceptible to supply and demand forces that can trigger price fluctuations. Sure, adding gold to your stock market portfolio stabilizes it. And while you don't lose money, you also don't see any particularly noteworthy profits. It's due to the fact that gold doesn't pay interest or dividends or see a growth in value. Number 6, gambling and investing are exactly the same. People presume that by doing this, their perspective on investment will be simplified. For those who have done it before, strategic investing is scarcely thought of as a gamble. Investing is merely a chance to get quick money. Although you anticipate a stock's value to rise after a purchase, this is rarely the case. One of the key distinctions between investing and gambling is that with investing, you're purchasing a definite stake in the company. When you consider gambling, you'll see that there is absolutely nothing of value you are receiving in return. When you exchange cash for chips in a casino and place your bet, if you win, you get more cash back. However, if you lose, all of your money is gone, and there is no way to recover the cash you initially invested. Number 7, the market is consistently outperformed by experts. Studies show that some experts can occasionally outperform the market. Though you might perform better with a low-cost fund, do you really have to outperform the market? The primary goal of investing is to achieve the long-term financial objectives you've established for yourself, not to outperform the market. Professionals can help you reach your financial goals, provide you wise counsel, and manage your money for you, but they won't always outperform the market. So you shouldn't hold this expectation of them. The majority of them act in their own best interests and fill their own pockets. The best course of action for you would be to use a financial advisor's expertise. Number 8, investing is best done on the stock market. Invest in your areas of expertise if you wish to increase your wealth. Start investing in things that will give you an advantage over other investors. Most investors ignore this advice and make investments in sectors they're unfamiliar with. They invest their money in stocks that are always rising without understanding why. There are an infinite number of investments that may be made. Among the others are commodities, real estate, bonds, and currencies. For the majority of investors, a portfolio with a heavy emphasis on stocks may be appropriate. However, if stocks aren't your thing, put your attention elsewhere. Stock investment is perfectly acceptable, but it's best to focus on your strengths rather than weaknesses. Number 9, investing internationally is far too risky. If you examine the present markets, you can notice that investments made in the US are performing better than those made elsewhere. But before you fully dismiss foreign investments, you should also take a look at the period from the year 2000 to 2009. Although it depends on the country or market you invest in, investing internationally offers investors a significantly higher return on investment and the possibility of substantial gains. Therefore, adhering to this statement may prevent you from making some potentially varied international investments that could be quite profitable for you. Number 10, to invest, you need a sizable sum of money. People have been discouraged from investing because of misconceptions, but in reality, you don't really need much. They typically picture high-powered Wall Street types with millions of funds at their disposal when they think about investors. However, anybody can invest. One of the best-known businessmen, Warren Buffett, is thought to have begun his financial career with a stock share price of $38. Many investing firms have minimal standards, while others have none at all. Brokers have recently created apps and tools that let you start investing with very little money. You can start with even your spare change. Think about routinely investing little amounts of money. Over time, this will lessen the risk associated with market conditions. You could consider investing in index funds or fractional shares of a company. Beginning small also allows you to begin sooner, as it becomes more difficult to set aside money for investments as you become older due to increasing financial responsibilities. Now that you're aware of the truth behind each of the common myths about investing, you'll be able to make necessary adjustments to your plans the next time you encounter one of them. Even while not everything we see or hear is accurate, there is one major focal point on which we can all agree. Making investments with our money can help us build wealth. That concludes today's video, which we hope you enjoyed and learned something from. If you liked this video, don't forget to give it a thumbs up and subscribe to the Inlet Financial Coaching channel if you haven't already. Thanks for watching, and we'll see you in the next video.